Boop. All right, that should be it. Yeah, I don't have my QuantBox or TRADARS or Investor Bootcamp or TradePlans.ai cup today, but I have had this one for 30 years. Yeah, so anyways, good morning, everybody. Comment allez-vous? How are you? Welcome to QuantBox Live. It's about 7 o'clock on Wall Street. It's 2.5 hours before the open of trading. It's time to get our global macro on. Uncover the best fundamental opportunities. We're going to look at the global markets and analyze direction of. We're going to look at individual assets. Are we going to look at the commitment of traders report today? Nah, probably not. What about the central bank forecast? Well, yeah, ECB, Kenyatta, all that kind of stuff. Yeah, we probably could. Of course, we're going to look at real-time sentiment. This is what we look at for the underlying intrinsic trend. And this is an extremely important page because you can't directly see the intrinsic underlying trend. What happens is people place bets based on what they think is going to happen, but they ignore what everyone else is doing. And that's a problem. That's a real problem. That's where many people, even professionals, go wrong. But in this case, we have this data. So it's there to protect you, to know when to be cautious, but also when you've caught a trend, you have the confidence to let it run. So what we're trying to do is organize your thought process of trading and investing in this way. You have a logical reason why you want to buy a bunch of assets. You have logical reasons why you want to sell a bunch of assets. Everything else is in the middle, and you kind of just are a wait and see on those. Much better way to trade than randomness or just trade habitually. That being said, if you're on YouTube, you should take the demo, man. Take the demo. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Let's log in to the Pro. I guess I could take a look at the AI alert service, which is an upgrade for everybody. Let's take a look. I'm going to grab my phone. QuantBox Market Open Report came out an hour ago. There's the pre-London report. This is the pre-New York report. CAD yen went bullish. Euro CAD, that's interesting, went bullish. It's interesting. We have USD CAD became more bearish. And we have USD Rand also more bearish. So interesting where it's saying Euro is strong and CAD is strong, but Euro is stronger than CAD. So you can read two things into that. CAD strong, but Euro stronger. Interesting. And so that gets emailed pre-market open, and that's less than $1 a day for the upgrade. Cool thing about that is it also reads the COT report for you on the weekend. And the reason I say it's cool is I used to spend a lot of money. I can't remember what it was, $300 a month to get the COT report, a report of the COT report. Because in the beginning, I did it manually, and then I paid a service to do it. And that cut my time down from basically an afternoon down to a couple of hours or 1 hour. And now QuantBox, I got this down to about 20 seconds. So in my career of being a professional investor for the last 20 years, the process went from an afternoon to 20 seconds. Thank you, QuantBox. That's just, to me, it's just amazing. All right. So here we are. Here we shall be. All right. I like, for some reason, to start to the top right. I don't know why. Maybe a past life. I was an Egyptian pharaoh and I read right to left. Who knows why? But I like to start here. And this is another day. I think it's 3 days in a row now of yields coming down, and that is a good thing. And what this is telling us is the bond market believes the Fed's going to cut twice this year. That's what it means. See? Yeah, that's what it means. So that's interesting. Okay, because we the yields rose when we thought it's only going to be one, but now we're swinging back the other way because we're getting more economic data. Inflation's still hot, but everything else is cooling off. Some of the ISM stuff is, like manufacturing's contraction. So we're in a manufacturing recession, kinda, not technically, but kinda. You can look at it that way. And so there's more and more reason why, if the Fed wants to, they can cut a couple times. All right. So we're swinging back the other way. Now I could go to the Fed watch tool and do, and go through it month by month, but I can just look at the yield. It tells me. The other thing is we have this tool, and about 3 days ago it went bullish again, and we've had 3 bullish days in the stock market. Hey, you're welcome. Isn't that cool? I added that upgrade, and it's working, baby. It's working. Because when it crossed up, the stock market was going down. And then when it crossed down, the stock market is going to go up. Okay, cool. Hey, look, I made this just ever so slightly easier to read. Isn't that nice? I pulled it in just a little bit. I did that. That's me. That's cool, right? So, neat. Jim wanted me to flip it, and I'm like, no, Jim, I'm not going to flip it. But I get it. I get it. Green is on the bottom, red is at the top. But that's just how it is. But yeah, so this is another form of the bond market, if you will. Okay, this is a note. Okay, and I mean these are technically notes too, but they're so much shorter. Anything like 1 year or less is a bill, a T bill. And these are technically these are both T notes, the 2 year and the 10 year. But anyways, we'll call this short term hot money. Okay, they're in it for now. If you're in it for 10 years, it's a different horizon. So hot money says, get out of the money market because it only pays, in this case, as of today, 4.77. Only pays 4.77. Now, are they moving to the 10 year? Well, that'd be weird to go from 4.77 to 4.34. Why would you want less? So that doesn't make sense. So where's it going? S&P 500, for example. The stock market. Why would you be happy with 4.75 when you can get 20% a year in the stock market? Okay, that's kind of the thought. Okay. This is a big deal. Money's moving out of safety and into riskier assets because they think they can get more than 5%. Okay, cool. Another way of looking at this is they think the Fed's going to cut twice. Okay, so if the Fed cuts 50 basis points this year, this asset will lose value. So if you think it's going to happen, you should act now. You see the logic there? Cool. So that's what's going on. All right, euro. Okay, sell yen, sell dollar, sell yen, sell dollar, sell dollar, sell dollar. So, on the daily evaluation already today, we have some risk on. Already today, that's pretty early. So let's take a closer look at both the risk gauges and the scatter plot. Okay. Risk on, risk on. And we're just kind of swinging around here. So if we have another risk on day, the weekly is going to go risk on, probably, almost certainly. So where are we with this weekly evaluation? VIX down over 10% week over week. Okay. Well, some people will tell you that volatility. Yes. The other way to understand it, beyond what sort of the media talks about, it's a fear gauge. Yeah, yeah. Yeah, it's a volatility measure. Sorta, yeah, yeah. But what's actually happening? Institutional investors are not hedging their investments in the S&P 500. That's technically what is happening. Well, why are they not hedging? They don't think they need that insurance. They think specifically the S&P 500 is more likely to go up than down, so they don't need the extra cost of insurance. Wait, what? No, this isn't a naked trade. They're not like dumping VIX. No, no, no. This is an insurance policy to protect them on their cash investment into the S&P 500. And they're like, "We don't need insurance on this. It's going up." Sweet. That's their attitude. We can read that. And these are not small investors, my friend. So they don't need insurance compared to, they were fearful last week, but not so much this week. It's changing, you see. It's changing. In particular, look, month over month, it's almost flat, but just in a week, like it's a big move since last week. So they're very much risk on. So I scored as a 1. Yields are coming down huge. 3 massive days. Like I'm telling you, like this, the 10-year bond market, if you want to call it that, the treasury market, has dropped like 1.5 to 2% each day for 3 days in a row. That is not a small move. And we're talking about big money. Think of it this way. How much money does it take to move the S&P 500? 2%. How much money do you need for a monster rally day in the S&P 500? Multiply that by 10, and you might be close to how much money is going into the 10-year in the last 3 days. What does that tell you? Risk on, baby, risk on. Interesting, huh? So I want you to understand the numbers. I don't want you to just see the numbers. I want you to understand the numbers. Okay? Yen is a little bit strong week over week, and that's bad. S&P 500 week over week is flat, but the volatility is crazy. So that's neither here nor there. Now, over the last month, it's still up 3%. It's not a bad month, right? Not June over May, but the rolling 30 days. Dollar slightly weak, but look at, compared to the week over week, compared to month over month, is about the same. Very, 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 very flat, huh? Just sort of like, but weak is good. Okay. This is where a lot of people get this mixed up. Even the media mixes this up. Dollar weak is good. A lot of people think down is bad. No. And gold is, slightly up. That's slightly negative. It's neither here nor there. Okay. So those assets aren't moving yet. Now, the thought process is, if people are correct and the economy is slowing down, eventually inflation will fall. It's not falling. It's stable, but it's not falling anymore. But the economy is slowing down, and eventually that will lower inflation, and therefore you don't need to own gold anymore. It's over. Sorry, gold bugs. People are going to trade that to the bitter end, aren't they? So you got to be careful there if you're trading gold. Be careful. Here's the money market page. It's nice and easy to see, huh? When it crosses down, buy the stock market. It's not too complicated. And these are daily. It's daily observations relative to an 8-day average. Okay. So when you're above, buy the stock market. Okay. When you're below, sell the stock market. No, no. Did I mess that up, didn't I? Wait. Whoa, whoa. Back up. Back up. Back the truck up. Okay. When we're above the red line, sorry, I totally messed that up. When you're above the red line, inflation is higher than normal. And by normal, I mean the recent normality of like within the last month or something, right? Unusually high inflation. So that's bad. And when inflation is lower than the average, that's good. So these crossovers, you know, pop, sell the stock market, pop, buy the stock market. Neato, right? Yeah. And then over here, just to define it, this is the yield, right? So think of it this way. Don't try to memorize what I just told you. Don't no. Let's take a step back to understand. Do you like it when the cost of money is going up? Do you like it when your rent goes up? Do you like it when your mortgage payment goes up? Do you like it when your credit card payments go up? Well, that's what's we're graphing here. That's the cost of money going up from 4.56, and it's going up and up and up and up and up and up and up, and even on one particular day we hit the psychological level of 5.0. That's bad. Now think of, if you don't like when your rent goes up or your credit card payment goes up or your car lease payment gets more expensive. If you don't like it, well, how do businesses feel about it? This is the cost of doing business. So if your revenue stays the same, but the cost of doing business goes up, you are less profitable. So how about the value of your shares now? Well, I thought the value of corporate shares had to do with the profitability of the company. Well, your cost of doing business is going up. You are less profitable. What happens to the value of your stock? It goes down. And there's a simple formula that everyone here has memorized. Okay. And we want to look at the risk-free rate of return. We'll substitute that instead of the Fed funds rate. You could substitute this, the 2-year treasury yield. The 2-year treasury yield is risk-free. You're lending money to the government. If they run out of money, they'll raise taxes. If they can't collect taxes, it's the United States. They'll just print money. You'll get your money back. It might be worthless, but you'll get it back. It's risk free for sure. Okay. So obviously there's still a risk, huh? They forget to mention this part. Well, what if you pay me back with money that's less value? Shh. We call that inflation. Okay. So, anyways, minus the beta okay, times the expected return of the market minus the risk-free rate of return. So now we have to measure the general market conditions. So the expected return of a particular stock is equal to this. Okay, pretty simple, right? So what does it mean? Well, if the yield here is going up, this is, think of it this way, this is your opportunity cost, right? So if you're spending money just to stay in business, you have less money to invest into research and development, to build, to expand your fabrication plant, to hire more employees, to move into new markets. You just don't have that money. So if this number is going up and we're using the yield here, the expected return of a stock falls. Okay. So once again, when I see this, um, that's what I see in my brain. Okay. So keep me close, as I said yesterday. If that doesn't happen for you, keep me close. Because I see that I'm like, boop. It's there. So cool. All right. So we don't want the cost of doing business in America to go up because that makes American companies less profitable and therefore the stock market comes down. Okay. Bitcoin, ripper awesome. Okay. Bitcoin, ripper awesome. Everything is up. Okay. Yields are down. Everything else is up, huh? All right. That's going to be an interesting day. Okay. Okay. Another dumb prediction today. Okay. There's going to be a vol trade on that. Is it reliable? Is it consistent? Well, this is why you pay money to have the data. We call that TRADARS. It actually costs money to develop. So yeah, so it's developed. You can know this stuff. So get a TRADARS subscription. Okay, QuantBox is going to be folded in anyway, so it's going to happen. So you might as well join TRADARS ASAP. What we're looking at right now is this is definitely a vol trade. It always has been, but is it consistent and reliable in the way that it responds, or is it just volatile for the sake of volatility? Well, that's bad. Volatility is bad. But what if you knew 80% of the time, based on the number that comes out, it the euro dollar falls? Right? Like what Sortino said to Bill Sharp. He's like, hey, you know what? There's good volatility and there's bad volatility. So that's the difference between the Sharp ratio and the Sortino ratio. And so you want to know, is it just volatility or is it good volatility? And TRADARS does that. It's extraordinary. Honestly, that it's extraordinary research. All right. Then later today, we got the Bank of Kenyatta, and their economy is a mess. Okay. Everybody's losing money except government employees. It's amazing because I actually read their report last night. Uh, and it's amazing. Like nobody's making money except government employees. But even then, it's so government. And you know, look, I'm Canadian, eh? So I can have an opinion on this. Um, you know, it's funny because last month wages for government employees went up 11.6%, And then this month they came down 6.4%. I'm like, wait, what? Month over month? How can you be up 11 and then down 6? I'm like, oh yeah, that's right. Government policy, right? Yeah. So all right. Good luck with that, Canada. There also in the data, there was a lot of like in the language, I read through it as basically union. Um, there's a lot of stuff like that. So like this is the part that's hard to reconcile. And when you can't reconcile something, it's almost always some form of government intervention. And I don't mean in Canada, I mean everywhere. So reconcile this. Productivity is near zero, at zero, or negative. But you have to pay your employees more money to do less. What the hell's going on there? Right? How does that even work out? That's bad math, right? You're like, wait, we're less productive than we used to be, but wages are going up incredibly fast. Well, look, if you want to solve your inflation problem, stop that. Stop doing that. Okay. Yeah. So, anyways, so that's a mess, huh? How could you have it wages up and productivity negative? Now, I think Canada prevented the recession because they came out with productivity at 0.1. Now, does anybody believe any government agency is capable of measuring an economy of 35 million people and getting it down to that level of accuracy? You're like, no, 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 no. No, it wasn't zero. It was 0.1. You're like, seriously? I mean, at least try to make the lie reasonable, right? You ever see the movie Super Bad, where this high school kid gets a fake ID so he can buy alcohol? And first of all, it says he's 25. And he's like, well, everybody lies. It says they're 21. And then all his buddies are like, dude, there's no way you're 25. How can you? And then, of course, is uh what was it? He had a name on there. It was just like a ridiculous name, right? And he's a high school kid, and his name is like McFly with no first name. His name is just McFly, right? And he's 25, and you're like, "Uh, not a reasonable fake idea. Anyway, so Canada's like faking that they're not in recession by like, oh no, 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 it's no, we're all good here. It's positive. Everything's good in Canada. You're like, dude, there's no way they know the difference between negative zero point 0.1 and positive zero point 0.1. And it's not a Canadian thing. It's just there's no way the government's that good at collecting that level of data and coming out with that level of accuracy, right? But hey, the United States does it too. Like, I'm not digging on Canada. Canada's a beautiful place with beautiful people. Yeah. Yeah. And everybody has a canoe. Yeah. What a wonderful place. You can trust people in a canoe? So, anyways, and then we got our services PMI this afternoon. That's a doozy. And yeah, we want it above 50. The higher, the better on this one. And we'll probably get it, but that's probably, our lingering inflation is here. So, one of the things we learned recently is on this side, the manufacturing, you can consider that goods, the goods side, if you will, is already contraction. Okay, this you could look at that and think recession, but 70% of America is here, so this can go in recession, and it won't really drag us down. Now, what I think would be interesting, like one major possibility for the near future in America, is that we bring manufacturing, a lot of it back. We bring a lot of it back because we do have a social problem going on. And you see that in the jolts that came out. And I literally studied this at Harvard, where we looked at we analyzed JOLTS. Like we broke it down, okay? Because the JOLTS report was something that my professor worked on at the Fed, because he, at the same time he was my professor, he worked at the Boston Fed as a senior economist, and one of the things he studied was JOLTS. And so we broke JOLTS down into excruciating, painful detail. And this guy, the way he thinks, everything is calculus. Oh my God. So, anyway, so we broke this down into great detail. And the conclusion was, um, 2 million people are looking for jobs, 8 million jobs are available. So, what's the problem? Well, the people that are looking for jobs can wash dishes or put sheets on a bed at the Marriott, but they're not AI developers. They don't build rocket ships for SpaceX or even Boeing for that matter, right? Like there was quite a spread between the jobs that are available, right? What we need versus what people can do. But there was no short-term solution. You can't just take, a maid that got laid off by Marriott and say, well, why don't you build rockets? Okay. So it takes a long time to solve that problem. But what if there was a government initiative to say, well, let's rebuild some parts of the manufacturing in the United States. It doesn't have to be everything, but let's do more. Like it's interesting, like Georgia is an interesting place to live. Georgia in the United States, not Georgia on the other side of the world. Georgia, the state of Georgia is interesting because, well, if you've studied the history of Georgia, there was cotton here. Okay, now it was a big industry for a very long time, but you can drive through Georgia, and there's these old towns with beautiful old homes. There was definitely money, and it's all gone to shit. And I curse because you should see the places now. And you're like, oh my God, but it used to be nice, right? And what happened? The mills shut down. And then there were mills, but then there were factories, and so they would take the cotton and turn it into fabric, and then there's someone would buy the fabric and turn it into t-shirts or socks, and of course all of that's done somewhere else now, right? And so all those towns are just empty, like 90% unemployment, kind of empty, and high crime. So, but wouldn't it be interesting? Like, I don't think you're going to bring that kind of like, you're not going to make socks in America, but it'd be interesting if we can get back to having some parts of America that are factory intensive and people could just get jobs that don't require a PhD in mathematics, right? I, just for the sake of stabilizing society, right? Like when you watch movies of the 70s and 80s, if you weren't there, there was this like anything with Bruce Springsteen singing in the background. America was great and we did things right. We built really crappy cars, but we built them. They were ours. Um, yeah, but there was a strong, like there was a pride around blue collar. We're Americans, right? We build stuff and then we go play baseball and drink beer, and that's American way, right? Yeah. So good, good. Let's bring that back, right? I miss that pride from the early 80s, right? Born in the USA. People had pride. And when I moved from Canada, it was really interesting. I'm like, dude, everybody's got American flags hanging everywhere. Like, we don't do that in Canada. You're just like, whoa, there's American flags everywhere. Right? Yeah. So, wow. So let's bring that back. And we know this from things like this PMI, but we can also break down JOLTS, which are job openings and turnovers. We can look at the unemployment, who is applying, and even more concerning than this, like this isn't concerning. It's the out of the workforce people. Why are they out of the workforce? And what can we do to give them self-respect? Okay. Yeah. Well, let's bring back manufacturing. Let's make our own drones. Yeah. All right. So, anyways, skip. Mm, guess we should just tie into this. Yeah, we kind of already looked at this, right? See, like on the dashboard, we skip all this kind of neutral stuff, but there's enough very bullish things. But they are like, again, we talked about gold is maybe being an opportunity because it's bullish and it's negative too, but maybe it's negative too for a reason. Maybe now some of the economic data is changing, showing that the economy is slowing down, and then eventually you would assume inflation comes down, and therefore you don't need to own gold, and people are already making that bet. Okay, yeah. Sorry, you still have to do some thought, but we at least you have the data available to you. So you'll have to decide along the way. And the way I teach you, by the way, technically, the way I teach you technical analysis, and the way I explained this the other day, if you're a bull and the market's bearish, you don't buy it. You wait. Why do we do that? Because if you're wrong, if this is not a dip, but instead gold is slowly going from 10 to 9 to 8 to 7 to 6 to 5 to 4 to 3 to 2 to 1, and it's falling because the economic conditions are changing, you're not going to get any buying opportunities. The way that I teach you technical analysis, it prevents you from buying while it's falling. So you just miss it. Well, it's better than losing money. And you can look back and say, "Oh, I should have known. I should have known." Okay. Well, it's hard to know all these things all the time. So watch gold. This is why I ask you to go to your gold chart, type in QuantBox equals 10, and then tomorrow you log in, and all of a sudden it's now an 8. So you change it from a 10 to an 8. Now you see it falling. And then on Monday, or it might be a 5, and it's no longer very bullish, it's only bullish. And then you're tracking it falling, and you're like, that explains why you're not why the chart is bearish, and you're not getting opportunities to buy it because, well, the logic for owning gold has changed. Okay. You can't just look at this. Okay. Now, most of the time that works, but like, for example, euro dollar. Okay. There's a slight bullish trend. All right. That's true. Okay. Swiss franc versus yen. Oh, yeah. There's a technical trend. It's bullish. Yeah. Okay. Cool. So this is either the opportunity or the warning, and we don't know. Okay. Now, with gold, the market is still quite long, huh? How does retail feel about gold? Mhm, mhm. Iron ore, copper, silver. Gold is way out in the middle, huh? 50-50. Okay. There's no metals on the bearish side. So all the metals are either neutral or bullish. And that's what you have with persistent inflation. Okay. Again, when we look at institutional investment, gold is very much bullish, much longer term. Okay. Silver is bullish, platinum, copper. So you have precious metals, you have industrial metals, and institutions are long that. Again, persistently high inflation makes you want to own real assets, not financial assets. Right? And I just want to bring this up because tomorrow we have the ECB, and there's likely to be volatility around this asset, whether it's euro dollar or some other asset, euro yen, or maybe around a cross pair, euro Aussie, euro CAD. But we're basically at the 20-day average. Slight uptrend still. So there might be an opportunity there. So the ECB might make money cheaper. Right? So you can maybe compare this, like I said, to a cross asset. I don't know, like if money is cheaper, that might be good for Europe. Okay, good. So let's just pretend you have to pick one way or the other, or maybe have different contingency plans. You could argue, you could go through this process two different ways. The ECB cuts and it's good for Europe, or the ECB cuts and it's bad for Europe. Good and bad meaning the direction of the euro itself. Okay. We don't know how the market will respond. We don't know if they'll cut, but let's just say they do. But, you have all these hypotheses. And then you say, well, if it's good for the euro and the euro goes up, which one of these underlying assets are the weakest in your opinion? Is Aussie weaker than CAD? Is CAD stronger than pound? Or is pound stronger than Kiwi? You can find this by looking at your charts. We call it relative strength exercise. I also create on my charts indexes so I can actually just tell you, but you should know how to do it. And then you develop your contingency plans. I'll just pick one. Let's say you're most bearish on CAD. So then you go to your chart and you say, okay, if Europe cuts and the market responds favorably to the euro, then you want to buy euro CAD, and then you set all that up on your chart. Then you do it reverse. Let's say they cut and the market responds negatively and the euro tanks. Oh, well, which one are you most bullish on? So let's say you happen to be very, very bullish on the pound right now. Okay. So then you go to your chart, you set everything up, and so you want to sell if the euro weakens. So great. At what price looks like resistance to you, and you put down little plans. And then when the news comes out tomorrow, you got your euro CAD on the left, ready for some up, or euro pound on the right, ready for some down. and you play the game smart. It's not too bad, right? Yeah. Cool. I think that's it. I think we'll leave it there. So I'll see you later today. Don't forget ADP. And if you want to play around, because that's part of the labor market, I don't track it here. I don't think it's necessary. But we have non-farm payrolls this week. On Friday, we have unemployment claims on Thursday. We just did JOLTS. Okay, we're tracking inflation through wage growth. So you can always go through this. Go through it. Okay. And they're pretty. I made some adjustments. Some of them are pretty. Okay, so like we had jolts the other day. Was it yesterday? Seems like 100 years ago. And we track all of that. Okay, came out 8.1. Okay, 8.4 was expected. The previous month was 8.49, and the average is 8.77. We have a level of detail here that only a few institutional investors would have. When we're breaking it down like this, it's so cool. So the trend is in the right way. Okay. And that shows a cooling economy. And now you know why the bond market is behaving the way it is. The money market, because of that, is falling. Okay. Since May 31st, right on schedule, right? And we know why, because we have data that is showing things like things are cooling and the Fed could cut. Cool. We want to track this because, especially if we can get above 3.8, in particular, I think the psych level is 4.0. Once again, that would allow the Fed to cut. We looked at jolts. Well, we're below average and trending down. That can allow the Fed to cut. One of the things coming out tomorrow is this. Now, I made a couple of changes here. Now, this is not your typical stacked bar, but I like the way it actually displayed. There are three different bars stacked. Instead of putting them side by side by side, I took the three individual bars and just put them in a row. And we have the claims and the forecast. So the forecast was 218. The last one we got was 219. Cool. But we got a revision and we put the revision here. So the previous week, it was 220. It came out 215, way better than expected. And then it was revised up a little bit to 16. So these are separate. The red bars are just the, let's say, the real numbers. They had more time to get the numbers right. Okay. The gray areas are just what was expected. So the revised number is 216. What was expected was 220. And what actually came out was 215. But then again, it was revised to 216. I don't think I can change the order if you're like, oh, this is good, but the order is it's out of order. Oh my God. But anyways, and then the average is 200K right now. So this number, okay, this everything is going to move to the left tomorrow because we're going to get a new number, expected, actual, and that'll be to the right, which means everything has to move to the left. And then this 218 will get revised. And so then we'll stack the red on top. Okay. Yeah. 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 So to me, these are the real numbers, huh? Now, the Fed wants these to be going up. They don't want people to lose their job, but they want to know that the labor market is cooling. So not long ago, we were at 208, huh? And then we were at 232. And they kind of and then 223, now 216, and it's going the wrong way again the last few weeks. And the Fed would rather have this slowly going up just to show that the economy is slowing down. So like jolts are the job openings. So we have less jobs available. They also want to see more people without a job to show the economy is right? Cooling. And they want just a bit of a trend, and that would give them enough to cut, which would then spur the economy to get people to have more work again. It's kind of weird, right? And then, of course, Friday we have non-farm payrolls, and this is unstacked. This is the side by side by side. Average NFP right now is 263. Isn't it nice to just be able to see this? And you'll once you start having this data, you'll lose respect for the financial media. Because what'll happen is they'll come out like the expectation. You ever wonder where that number comes from? Well, what's expected for the next non-farm payrolls, right? What you'll find out it'll be like the 3-month average. Like that's it? Yeah. Then why do we say they? Like 50 experts got together with deep, deep, deep data and the most ridiculous artificial intelligence given to us by like an alien species that visited us secretly, and they're like, we can predict the future, right? No, what do you mean they expect? The market expects. It sounds intelligent. Why don't they just say, well, the 3-month average is right, 263 something. Now this is the average. This is the long term average, but maybe I can see if I can throw a 3-month average on there. I don't know if I can do that. I'm not that smart. But very often that's all it is. And you're like, wait, there's no they to that at all. That's just the 3-month average. No experts need to be involved with add the last three NFPs and divide by three. Okay. So, anyways, so we have some interesting data. Yeah, we have some interesting data. And that's going to be Friday. That could be interesting, huh? And I don't know if you looked at this. This is the headline number minus the forecast. Okay. So on May 3rd, we thought 238. We, the alien species with advanced artificial intelligence that can divide by three. Okay. And then what? It came out buck 75, way less than expected. I don't know if this is helpful. I don't know. Maybe. I don't know. It's there. I can do it, so I did it. I guess I'll keep working on it. Like I'm an artiste. I'll work on different ways of displaying this for us. So actual So if you go back to April, 212 was the forecast. And it came out 303. And then it was revised 315. Oh my God. Yeah. Well, for this one, it was chunky. And it didn't look good, I guess. So I played around with it. Actual expected revised. That's all it is. And what happens is when when you display them like this, they get all chunky together and stuff like that. You know. Um, and I guess if you saw what I was looking at, and you're like, oh, there must be a better way. And what I did, I clicked a button that said stack them, and I'm like, oh, well, that's different, and it is clean. So I know it's not the traditional way of using it. So I get it. You wouldn't normally use a bar like this, but it's one way to separate them. So I don't know. Um, yeah. So I don't really care about the expectation. The actual is good, and revision is good. Most people miss the revisions. So I just see the reason I like this, and I can change it. Like I'm not, but the way I like this is the way I think is I can tune everything else out. I sit at the dinner table sometimes, and then they're like, "Well, what do you think?" And I look at my wife and kids. What? Did you just tune us out for the last 20 minutes? I'm like, I don't know where I am. I'm still wearing my slippers. Where's the White House? I gotta go to the White House, right? Yeah, yeah. Where's the Situation Room? I gotta go to the War Room. Like, no, you're not Joe Biden. I'm like, right. I lost my documents. So I just separate this, right? I'm only looking at the red. So I see now just the red. And I see 212, 212, 212, 222, 212, 212, 212. Hey, that's pretty amazing government work, right? You know, they just got together and they're like, I don't know, let's just do 212 again. That seems to be good. That's right. And then 208, 209, and then popped up. And so I'm just looking at these revision numbers, right? That's all. And then I look down here. Okay, what actually came out? 209, 210. But again, if nobody likes this, it's fine. But notice the long-term average now is 200,000. And so it's been coming out over that. So if we're significantly higher, if this starts coming out 230, 240, that gives the Fed to cut. If it's coming under that, the Fed's not going to cut. Okay. So, anyways, but look at all the stuff that's being done for you because, well, you're making an investment, and I hope you see that it's being reinvested into research and development so that you have better and better tools to make better and better decisions, or at least more informed decisions. And there are more changes coming. They've been worked on for 6 or 7 weeks. They're coming. They're on their way. So stay tuned. Stay close. Peace on earth. May the pips be with you. May our profits be above average. I'll see you later. Cheers.